This chart is showing us how little the S&P is moving relative to the rest of the world equities. So if we look at MSCI World 10-day realized over S&P 10-day realized, that ratio is near 2.4%, which is pretty much a 5-year high. It just shows you that, you know, there's stuff going on in the world and the S&P really doesn't care. Now, if you look at these spikes, generally they don't tend to last that long, especially when they get this extreme. So that either means the rest of the world calms down. So you look at these spikes, it goes up there and then it comes back down, right? It goes up there, comes down, goes up there, comes down. So we're up here. Either the rest of the world calms down or the S&P starts moving a bit, basically. But the idea is we're thinking based on this time series going back to 2019, it's looking a bit extreme, right? So we would think that the 10-day realized of 7 on the S&P probably has some room to go higher, right? It's kind of what I would guess, right? Obviously, you could get the rest of the world calming down and moving less. It has obviously been moving a bit after what's going on in Europe last week. So maybe that's the way it comes back down. But, you know, on a relative basis, S&P does look extremely low right now. Now, another reason why maybe there are reasons to get nervous is that if you look at the NASDAQ and the vol on the NASDAQ, which is the Vixen, we did see spot up, vol up price action, right? We have seen that recently. NASDAQ's exploding to the upside, vol's going up with it. Now, why is that a problem? Why isn't that super bullish? It can be bullish, but it's not healthy. It's not necessarily a healthy bullish, right? Because what it tells us is that there's probably instability in the options market, right? When it's healthy bullish and it's sustainable and it's a nice, slow, long-term uptrend, you get markets grinding higher and you get vol getting sold to dealers, and, you know, it kind of keeps it all nice and orderly. There's not these big spikes in vol on the upside, right? And that gamma that dealers are getting is quite supportive to the market. Any drawdowns, any selling gets absorbed quite easily by the players who are long gamma. Now, the move that we've seen just now suggests that people aren't necessarily as long gamma on the NASDAQ, right? Because the fact that vol's going big on the way up. So they may have moved away from their gamma. They may have been taken out of their gamma. Whatever it is, the chances are they're less long gamma than they were. And that is a potential sign of instability and sign of risk. So we may need to we may get this reversal. This is what happened in Volmageddon, where we saw a move higher in the markets. Vol went bid with it, and then we got this sudden, really fast, violent reversal. Now, you probably don't get a fast, violent reversal unless there's a piece of news that's actually going to spook the market. But just knowing that under the hood, there's more instability building here from signs like this, where we see vol up, spot up, vol up, that should make us a little bit more cautious and should kind of add to the conviction of hedging out longs that we may have. Maybe you don't want to go short. Maybe that's not your style, but at least getting yourself hedged so that your longs are protected, I think, is a sensible thing to do on the back of these things that we are seeing. Yeah. That's kind of what I'm thinking there, right? And then the last reason, again, is that the buyback blackout, right? So that started, we've got middle of June here. That's where we are now. That's kind of half the companies. And, you know, by the end of June, every company is going to be in buyback blackout. So if we're in buyback blackout, that just means less kind of indiscriminate buying from these corporates that supports the market. You know, run rate was maybe in the order of magnitude of $5 billion a day. That bid essentially is less than it was before. So again, if we have a reason to sell off the indiscriminate buyer that is supporting markets and meaning that the sell-offs never really turned into anything too sinister, that buyer has gone, which might again mean a bit more of a pullback to the downside than we otherwise would have got if that buyback bid was there, basically, right? And then that buyback bid will restart again in July. And, you know, if we've had a correction, then that buyback condition would then actually be a tailwind. But right now, it's potentially a little bit of a can't speak. It's a little bit of a headwind right now, as these names are going into blackout for earnings. Okay.